Bismillahirrahmanirrahim. This is the fourth video on financial statement fraud. In this video, we will discuss cases and exercises related to financial statement fraud. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. A special word of thanks to Mr. Khalid Zaid, a final year student of Management Science Department, Yambu Industrial College, who assisted me in collecting relevant exercises and cases on financial statement fraud. So let us start with the first case. Ace Company is a manufacturer of electrical appliances. The following transactions occurred near Ace Company's December 31st fiscal year end date. A packing case containing products costing 10,000 was found in Ace's branch office warehouse where the physical inventory count was taken on December 31st. The case was labeled hold for shipping to customer on January 5. The shipping documents show that the sale of ACE's customers is FOB shipping. For the preparation of ACE's December 31st financial statements, which of the following is correct? A. The packing case should not be included in ACE's December 31st inventory. ACE should recognize a sale in respect of the inventory's selling price. So, option A is incorrect because ACE cannot recognize a sale before 5th of January, the date that is agreed upon for shipping to the customer. So, A is not correct. Then, number B, the packing case should be included in ACE's December 31st inventory. ACE should recognize a sale in respect of the inventory selling price. Once again, option B is incorrect because of the same reason. ACE cannot recognize a sale before 5th of January. Then option C, the packing case should be included in ACE's December 31st inventory. ACE should not recognize a sale in respect of the inventory's selling price. So option C is the correct choice, as ownership of the goods typically transfers from the seller to the buyer when the goods are shipped as per the FOB shipping terms. In this scenario, since the goods were still in ACE's possession at its branch office on December 31st, ownership hadn't transferred to the customer. Therefore, ACE should include the packing case in its December 31st inventory. Then let us look into number D. So C is the correct answer. Number D, the packing case should not be included in ACE's December 31st inventory. ACE should not recognize a sale in respect of the inventory's selling price. So once again, option D is also incorrect because the packing case should indeed be included in ACE's inventory until it is shipped to the customer. Let us move on to the next exercise. Bolt Company, a clothing manufacturer, encountered transactions near its fiscal year end date of December 31st. The transactions are outlined as follows. Item number 1, merchandise costing 5,000 was shipped to a retail customer on December 27th. The merchandise is part of the consignment agreement with the retailers. The goods were received by the retail customer on December 30th and were on the customer's shelves and available for sale on January 2nd. So, and then we have item 2, merchandise costing 3000 was shipped by Bolt to a retail customer on December 26th using FOB shipping. The merchandise was received by the retailer on January 3rd. For the preparation of Bolt's December 31st financial statement, which of the following options is correct? So, option A, both item 1 and item 2 inventory should be included in Bolt's December 31st inventory. So, option A is incorrect because item number 2 inventory has indeed passed from Bolt to its customer. So look at number B, item first inventory should be included in Bolt December 31st inventory, while item 2 inventory should be excluded. So option B is the correct choice because item first inventory should be included in Bolt's December 31st inventory because under a consignment agreement, the ownership of the goods remains with Bolt until they are sold by the retail customer. Let us move on to number C. Bolt should recognize sales in its income statement for both item 1 and item 2. So option C is also incorrect because the goods sent on consignment are still considered as part of Bolt's inventory until they are sold by the consignee. And finally, option D, Bolt should not recognize a sale for either item 1 or item 2. And option D is also incorrect because item 2 inventory has been sold based on FOB shipping terms. Okay. Now, Push Company, a lawn mower manufacturer, encountered a scenario near its December 31st fiscal year end. The details of the transactions are as follows. Push Company, falling short of meeting its sales estimates for the fiscal year end, anticipated a substantial order of 40,000 of lawn mowers from Pull Company, a major customer, in April of the following year, with delivery expected in May. In December, Push proposed to Pull that it place its upcoming April order immediately, offering Pull a significant discount for early placement and agreeing to hold the inventory until May for shipment. Pull agreed and submitted the order to Push on December 29. Push stored the goods in its warehouse in December and recognized a bill and hold sale for the goods on December 30. The goods were subsequently shipped to Pull in May of the following year. The bill and hold sale should not have been recognized as revenue in Push Company's December 31st financial statement because number A, Push Company initiated the early order for the bill and hold transaction, not Pull Company. So option A highlights that the buyer and not the seller must initiate the request for a bill and hold the sale for revenue recognition before shipment. So option A is correct. There is number B now. There is no indication in the transaction description that Pull Company had a substantial business purpose for ordering the goods on a bill and hold basis. Now, option B emphasizes that the buyer must have a substantial business purpose for requesting a bill and hold sale, enabling the seller to recognize the sale before shipment. So, option B is also correct. Option C. With a bill and hold sale, the seller recognizes revenue in its income statement but does not recognize cost of goods sold. Now, option C is incorrect because in a bill and wholesale, the seller typically recognizes the cost of goods sold along with recognizing revenue. So, therefore, the correct response would be option number D, as it accurately reflects the combined correctness of A and B. So, option D is the correct answer. We move on to the next exercise. On December 20, Z Company, an office supply firm, initiated an order for goods from Papyrus Company, a paper manufacturer. Z requested the goods to be shipped only in March of the following year, FOB destination, with a corresponding clause included in the sales contract. Z placed the order in advance to ensure receipt of the goods in March in case Papyrus Company faced inventory constraints the next quarter. Papyrus Company should not have recognized the sale to Z Company as a bill and wholesale in its December 31st financial statement because number A, the buyer must have a substantial business purpose for ordering the goods on a bill and hold basis. So, option A is incorrect because the buyer indeed had a legitimate business reason for placing the order early, which does not invalidate the transaction. Option B, bill and hold sales recognize revenue from a sale but do not recognize the cost of goods sold. Now, option B is inaccurate because in bill and wholesales, both the cost of goods sold and sales revenue are recognized. Okay, look at number C. The risk of ownership must have transferred to the buyer. Now, the rationale behind selecting C is correct. And the rationale behind this is that the FOB destination clause in the sales contract delays the transfer of ownership risk to the buyer until the goods are shipped in March. Hence, the sale cannot be recognized in December when the order was placed. We move on to number D. So Z company had not, so C is the correct answer as of now among A, B and C. Let us see D. Z company had not paid for the goods by December 31. So this is also incorrect because sales recognition does not hinge on whether the goods have been paid for or not. So option C is the most suitable response as it reflects the correct understanding of the scenario. Now, XYZ has finalized its financial statements for its fiscal year ended December 31st. At this stage, all of its transactions have been recorded properly in accordance with GAAP. On January 10, XYZ company is contemplating securing a backdated order for a bill and wholesale from one of its customers. The backdated order would be for goods with a selling price of 10,000 and a cost of 4,000. The goods would be delivered on February 28, 2 months after the year end. The order would be backdated as though it were placed on December 28. Now, if XYZ company proceeds with securing the backdated order and recognizes it as a bill and wholesale in its December 31st financial statement, which of the following statement is correct? Number A, operating income would be overstated by 6,000 and sales would be overstated by 10,000. So option A is correct, and the justification is that the backdated order increases sales by 10,000, thereby boosting the operating income by 6,000, that is 10,000 minus 4,000. Let us look into option B. Cash flow from operations would be overstated by 10,000. Now this is incorrect because there would be no overstatement of net cash flow from operations. So B is not correct. CFFO would be overstated by 4,000. So option C is inaccurate because there would be no overstatement of CFFO. And then finally option D, net income would be overstated by 10,000. So for option D, this is also incorrect because net income would be overstated by 6,000, disregarding any income tax implications. So option A is the most appropriate answer, aligning with the proper understanding of the situation. Okay, let us look. If XYZ proceeds with the securing the backdated order and recognizes it as a bill and wholesale, which of the following statement is correct? Now, this would cause operating income to exceed by 10,000. This would cause CFFO to be 6,000 smaller than operating income. This would have the same effect on both operating income and CFFO, and this would have no effect on operating income but would increase CFFO by 6,000. So if you look into these options, option number B is the correct choice. And the reason behind B is that while operating income would increase by 6,000, that is 10,000 minus 4,000, cash flow from operations would remain unaffected. So to calculate CFFO, that is cash flow from operations, we will subtract the 10,000 increase in accounts receivable and add 4,000 decrease in inventory to the additional operating income of 6,000. So option A, C and D are incorrect as they do not accurately reflect the impact on CFFO. So answer B is the most suitable answer in the given scenario. Okay. Mac Company accurately prepared financial statements for its December 31st year end show on accounts receivable balance of 50,000, operating income of 25 and CFFO of 24,000. Mac has an inconclusive sales transaction to supply Donald and Company with merchandise costing 10,000 and a likely selling price of 15,000. A sales contract was not fully agreed upon by December 31st. If the transaction is completed, the merchandise will be delivered on January 20 and paid for on January 30. Mac had the goods on hand on December 31st. Now, if Mac proceeds to recognize a sale of 15,000 in its December 31st financial statement for the inconclusive agreement, which of the following statements is correct? Number A rather. So cash flow from operation will increase by 15,000. So this is incorrect. CFFO will increase by 10,000. This is also incorrect. Operating income will increase by 15. This is also incorrect. So answer D, option D is going to be the correct one. So A, B and C, all three of them are incorrect because they do not accurately represent the impact on operating income and cash flow from operations as a result of recognizing the additional sales. But in the case of option D, the operating income will be stated as 25,000, the original, plus 15,000 of additional revenue minus 10,000 of the additional cost, that will be equal to 30,000, and this is reflecting an increase of 5,000. So option D is the most appropriate answer given the circumstances described in the question. Okay, if Mac proceeds to recognize a sale of 15,000 in its December 31st financial statement, which of the statements is correct? Uh, the accounts receivable balance will be stated as 65,000, and this is correct because account receivable will be 50,000 plus 15,000, that is 50,000 plus 15,000, that is 65,000. Operating income will be stated by 40,000, that is incorrect. Cash flow from operating will be stated by 39,000, that is also incorrect. And operating income will be stated by 25,000, so this is also going to be incorrect. So option B, C, and D are incorrect because they misrepresent the impact on operating income and cash flow from operations resulting from the recognition of the additional sales. So therefore option A is the most suitable answer in the given scenario described. Okay. Discuss whether the argument that recognizing future periods revenue in the current period is merely a timing error mitigates the impact of overstated revenue or diminishes the responsibility of the perpetrator to accurately report revenue in the current period. So, recognizing future revenue in the current period entails incorporating revenue from upcoming periods into the present financial statements. Consequently, the revenue that should rightfully belong to subsequent periods becomes attributed to the current period. Even if the fraudulent practice continues into the next reporting period, it merely shifts one period's revenue and earnings forward, while the current period sees an artificial inflation of its financial metrics. This discrepancy often leads to a temporary increase in the stock price in the current period, followed by a subsequent decline when the true financial conditions is revealed. Shareholders who purchase stock during the inflated period face the risk of financial loss as the stock price adjusts downward after the artificial spike in revenues and earnings. Perpetrators of early revenue recognition schemes knowingly present misleading financial statements. Any intentional attempt to deceive stakeholders resulting in financial harm constitutes fraud. Therefore, those responsible for initiating early revenue recognition bear the same accountability for the fraudulent activity and its consequences. Okay. What incentives do managers have to overstate a restructuring reserve in the current period, knowing they can reverse it in future periods, despite the fact that overstating the reserve reduces net income in the current period? So, managers are incentivized to understate net income in one period to overstate it in a subsequent period due to the accounting treatment of restructuring reserves. Typically, the expense associated with creating a restructuring reserve it is disclosed below the line of operating income, categorized as non-recurring expense. Consequently, its impact on the company's financial performance and stock price may be less pronounced compared to if the expense were recognized within operating income. Perpetrators of such fraud schemes release the previously understated reserve into earnings above the line of operating income in the future period, where the income is perceived as recurring. This deceptive practice artificially inflates the company's profitability and creates a false impression of financial health, leading to an unjustified boost in the stock price. Okay. Describe how a company's overstatement of its restructuring reserves may not necessarily result in the understatement of its operating income in the period when the reserve is overstated. So, companies often overstate a restructuring reserve to create a cookie jar reserve intended to be reversed rather into profits in subsequent periods. This manipulation involves intended the, involves disclosing the restructuring expense in the income statement as a special charge categorized below operating income. While this practice reduces net income, it does not affect operating income as it is positioned as a separate item in the income statement. Okay, discuss the reasons why a bill and hold sale leads to a delay in cash flow from operations compared to operating income. In bill and hold sales, both the sale and the cost of goods sold are recognized in the current period's income statement, resulting in an increase in operating income if the goods are sold at a markup. However, since the customer pays in a later period, there is no immediate impact on cash flow from operations when the bill and wholesale is recognized. In the indirect method of calculating CFFO, that is the cash flow from operations, the starting point is net income from which the increase in accounts receivable and other current assets is deducted, while decreases in current assets are added back. In the case of a bill and a wholesale, the transaction increases accounts receivable and decreases inventory, resulting in no net effect of CFFO. Okay. Discuss the reasons why downsizing a company by closing segments or product lines that report on accounting loss often results in a decrease in profit rather than an increase. Now, when a company closes a segment or product line, it faces the loss of all associated revenue from that particular operation. Many fixed costs within the organization, which are typically allocated across different segments, are not directly attributable to any single segment. Consequently, even if the closure of a segment could potentially eliminate certain expenses in a scenario of total liquidation, closing only one segment might not proportionally reduce overall cost. For instance, the expenses like the CEO's salary are unlikely to decrease following the closure of a segment. Instead, these fixed costs continue to be allocated across the remaining segments, which now bear a higher share of the total expenses. As a result, the remaining revenue experiences a larger decrease compared to the reduction in expenses, leading to potential decreases in reported profits for the remaining segments after the closure of a segment. Okay. So, what factors contribute to an increase in accounts receivable as a percentage of sales being considered a signal of improper revenue recognition practices? Now, the increase in the accounts receivable as a percentage of sales ratio suggests that recorded sales are growing at a quicker rate compared to receipts from customers. Now, this trend could indicate several potential issues, including a decline in customers' ability to make timely payments, premature revenue recognition, or even the inclusion of fictitious revenue. Now, while this signal alone does not provide conclusive evidence of any specific problem, it serves as a concerning indicator. Without a valid explanation for the rise in this ratio, it suggests a potential deterioration in the quality of reported revenue. Thus, it warrants further investigation to ensure the accuracy and reliability of financial reporting. Then, what factors contribute to sudden changes in gross margin percentages due to overstatements or restructuring reserves? A restructuring reserve may encompass a write down of inventory below its cost, typically reflecting the anticipation of selling the inventory at a loss. In cases where companies overstate their projected loss and write down the inventory during the current period, followed by selling the same inventory at or near the regular selling price in a subsequent period, it can result in a significant increase in the gross margin reported during later period. This is particularly true if the company includes the recognition of these sales in its disclosure of operating income. Such practices can artificially inflate the gross margin figures, potentially misleading stakeholders about the true profitability of the company. Okay. Please analyze the provided excerpts from Moonshine Company income statement and balance sheet. We have the income statement. Oh, I made a mistake. This is the balance sheet over the past 3 years and compute the accounts receivable to sales ratio. So, accounts receivable to sales will be in year 1. It is accounts receivable and divided by sales. So, year number 1, it is going to be 15%. In year 2 it will be accounts receivable divided by the sales, that is going to be 20%, and for year 3 it will be 37.5%. Now this is an interesting observation, uh, that the account receivable are increasing as a percentage of sales, and this could signal potential financial statement fraud related to revenue recognition. Like this may a possible scenario may be premature revenue recognition. So if account receivable increases disproportionately to sales, it could indicate that sales are being recorded before the company has actually received payment. This may suggest premature revenue recognition, where sales are recorded before they are earned, leading to an overstatement of revenue and profit. Another may be fictitious sales. A significant increase in account receivable relative to sales might also indicate the inclusion of fictitious sales in the financial statements. In this scenario, the company records sales that have not actually occurred, artificially inflating revenue and account receivable balances. Then, channel stuffing. Companies might engage in channel stuffing, a practice where excess inventory is shipped to distributors or customers at the end of a reporting period to meet the sales target. This can lead to inflated account receivable balances if customers have not yet paid for the goods or if the goods are returned later. Then another scenario may be extended payment terms. Offering extended payment terms to customers can also inflate account receivable balances, especially if the company records sales when the goods are shipped rather than when they are paid for. This can distort the account receivable to sales ratio and lead to misleading financial statements. So, in summary, an increasing account receivable as a percentage of sales could be indicative of various types of financial statement fraud, including premature revenue recognition, fictitious sales, channel stuffing, or manipulation of payment terms. These practices can distort financial performance and mislead investors and stakeholders about the true health of the company. Okay. Now, Saturn Company income statement for the current year shows 100,000 as its net income. Its depreciation expense is 5,000. The only changes to its working capital balance over the last year were that account receivable increased by 40,000, inventory decreased by 10,000, accounts payable increased by 5,000. What is Saturn's cash flow from operations for the year? So we have the net income of 100,000. We have depreciation that will be added for 5,000. There is a decrease in inventory by 10,000. There is an increase in accounts receivable by 40,000, so this will be reduced. And there is an increase in accounts payable by 5,000, and this will be added. So the cash flow from operation is 80,000. So when the only changes in the working capital balance involves an increase in accounts receivable, a decrease in inventory, and an increase in accounts payable, several types of financial statement fraud could be possible, like there may be revenue manipulation. An increase in accounts receivable coupled with a decrease in inventory could indicate aggressive revenue recognition practices. For instance, the company might be recognizing revenue prematurely by recording sales before the completion of delivery or even before payment from customers. This can artificially inflate accounts receivable and overstate revenue, leading to a misrepresentation of the company's financial performance. Another case may be channel stuffing, that is, if the decrease in inventory is due to excessive shipments to customers or distributors near the end of the reporting period, it could indicate channel stuffing. This practice involves artificially inflating sales by shipping excess inventory to the customers who may not need it immediately, leading to higher accounts receivable balances, and this can distort financial statement by falsely boosting revenue and accounts receivable. Another may be like supplier fraud. An increase in accounts payable might be indicative of supplier fraud if the company is deliberately delaying payments to vendors beyond the agreed upon terms. This can create a false impression of improved cash flow and profitability in the short run. However, this may strain the relationship with suppliers and lead to supply chain disruptions in the long run. Another may be inventory manipulation. A decrease in inventory could also be a red flag for potential inventory manipulation. For example, the company might be understating the inventory levels to artificially boost profitability or inflate assets turnover ratio. This can mislead investors and creditors about the company's efficiency and financial health. In summary, the combination of changes in accounts receivable, inventory, and accounts payable could indicate various types of financial statement fraud, including revenue manipulation, channel stuffing, supplier fraud, and inventory manipulation. It is essential for stakeholders to scrutinize such changes carefully and investigate potential irregularities to ensure the accuracy and reliability of the financial statements. Okay, before finalizing its financial statement for the year, Jupiter Company decides to establish a restructuring reserve of 20,000 in anticipation of a downsizing to be implemented in the following year. Jupiter's income statement for the year before creating the restructuring reserve is as follows. The company aims to create the restructuring reserve without reducing operating income for the current period. And this is what the information is. We are required to journalize and then restate the company's income statement for the year, considering the establishment of the restructuring reserve and assuming that it does not affect the company's income tax expenses. So, restructuring reserve, obviously, this is a restructuring expense. So, restructuring expense is going to be debit by 20,000, and restructuring reserve is going to be credited by 20,000. So that is what is for part number A. For part B, we have to prepare the income statement, and for this we have the sales, and the sales is for 160,000. From this, we are going to subtract the cost of goods sold, that is 60,000. So we have the gross margin, and gross margin is 100,000. From this, we are going to subtract the selling and administrative expenses, that is 40,000. So that gives us the operating income of 60,000. From this, we are going to subtract the restructuring expense of 20,000. So the income before taxation will be 40,000 and the taxation is 12,000. So that makes 28,000 of net income. Uh, Now, if a company restates its income statement by establishing a restructuring reserve without affecting its tax expense, then again there may be several types of financial statement frauds are possible, like earning management. Establishing a restructuring reserve without impacting income tax expense allows the company to manipulate its reported earnings. By creating a reserve for future expenses, such as restructuring cost, the company can artificially reduce its current period's net income, and this manipulation can serve various purposes such as meeting earning targets, smoothing of the income trends, or managing investors' expectations. Others may be cookie jar reserves, income smoothing, misrepresentation of financial position. So, establishing a restructuring reserve without impacting income tax expense opens the door to various forms of financial statement fraud, including earnings management, cookie jar reserve, income smoothing, and misrepresentation of financial position. It is crucial for stakeholders, therefore, to critically evaluate the rationale and implications of such accounting practices to ensure transparency and integrity in financial reporting. Okay, we go to the next one. You are a fraud investigator who has been hired to detect financial statement fraud for Chipmunk Company. You have been provided with the following information. Calculate that 2008 and 2007 liquidity ratio identified in the table below. Also calculate the changes in the percentage changes for the ratios and complete this table. Formulas are given to shorten the time spent. Okay, analyze Chipmunk's company ratio for both years and compare the figures with the industry ratios. Based on the ratios identified, where do you think fraud may have occurred? Okay. So we have the balance sheet, and this is for the year 2008 and 2007. We have the statement of income and retained earning for the year 2008 and 2007, and we have to fill up this table over here. Um, and we have to calculate the different liquidity ratios. We have the liquidity ratios like current ratio, quick ratio, sales ratio, number of days in accounts receivable, and inventory turnover. So if we take the current ratio, it is current assets divided by the current liabilities, and for the year, current assets divided by current liability will be 2.31, and for the year 2007 it will be the current assets divided by current liabilities, that is 2.49. So the change is obviously there is a decrease from 2007 to 2008 by 0.18. So the percentage average, there is a decrease of 0.18 over 2 point divided by 2.49, that will be 7.27%. Then we go for the quick ratio. For the quick ratio, we have the current assets, we have the current assets as we need, And from this, we are going to subtract the inventory that is there. And we are going to also subtract the prepaid expenses. And we will divide this by current liabilities. So current assets minus inventory minus prepaid expense divided by current liability will be 0.42, and we will have used the same for the year 2007, and that is 0.40. So the change is of meager 0.01, and so 0.02 rather. 0.4, yeah, 0.02. So the change and the percentage change is about 3.46%. Then we move on to the sales receivable, that is net sales. Now net sales is from the income statement. The net sales is 26,419, and this will be divided by net ending receivables, and the net ending receivable for the year 2006 is 1646046. So when we divide, this is going to be 16.05. We will use the same for the year 2007, that is 17.78, and there is a decrease of 1.73. In terms of percentage, there is a decrease by 9.73%. Then we look into the number of days sales in accounts receivable. So once again, we have the net ending receivables divided by net sales divided by 365. So we will divide the net sales by 365, and then the net ending receivables are given for the year 2008. So net ending receivables divided by net sales divided by 365, that will give us 22.74. Same for the year 2007, it will be 20.53. The change is 2.22, and the percentage is 10.80%. Next, we go for the inventory turnover, and that is cost of sales. And the cost of sales is 19,133. So we have the cost of sales divided by average inventory. So for the average inventory for 2008, we have the ending inventory for 2008, and the ending inventory of 2007 is the beginning inventory for 2008. So we will add up the two and divide by 2 to get the average. So cost of sales divided by average inventory, this for 2008 is 1.48. For 2007, again we have the cost of sales for the year 2007 divided by the average inventory. Now the ending inventory for 2007 is 12,356, and the beginning is 11,427. This is for the year 2007. So we are going to add up the 2 and divide by 2 to get the average inventory, and that is 1.39. So there is an increase by about 0.09, and it is 6.37%. So that's how we are going to fill up this table, and the decline you can see in the current ratio is by more than 7%. It is more than 7% over the year, and this raises concerns regarding the liquidity position of the company, particularly in its cash or near cash assets. This decline may suggest potential irregularities or mismanagement in managing the current assets. Furthermore, there is a considerable increase of almost 11% in the collection period of accounts receivable. The company is taking substantial longer than the industry average to collect its receivables, indicating possible issues such as channel stuffing or the creation of fictitious sales and accounts receivable. So, these trends warrant a thorough investigation into the company's financial operations and practices to ensure and integrate in its financial statement. So, this completes our fourth video on financial statement fraud. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.